Right now, should you own gold, silver, or cash? So the question is, right now, should you guys own gold, silver, or cash? Now, you guys know on this channel that I'm the sound money guy, the gold, silver guy, the commodity supercycle guy, the inflationary decade ahead guy, and you know what? So is Luke Gromen. However, before we discuss all this, and I'll share a whole bunch of information and charts with you, which I think you'll enjoy, let's just cut to a clip with Luke Gromen on this very question about owning gold, silver, or cash.
From Tumish, I hold commodity stocks, gold miners, gold royalty, uranium, Canadian oil producers, etc. I also have gold and silver. Should I try to lower my risk or not? I guess what I want to know is if markets implode, am I overexposed holding a lot of stock? I think it depends on your time horizon. If you're under 2 years, under 12 months in terms of your time horizon, yeah, I think there's real risk. If you have a longer term time horizon, 2 to 5 years, then no, I don't think there's a lot of risk in that position based on the sovereign debt being in a position that, again, there can be no problems anywhere ever again. We have a problem, and from there it's about risk management. And between here and there, again, deflation, and then how long till the end game with yield curve control. So, I mean, I keep coming back to no country with a fiat currency that I'm aware of has ever defaulted on its sovereign debt for lack of printing money. So again, I think it's all about that risk management. And I think right now, quite frankly, we're in a period of time where you need to be aware of your risk management. I don't think you want to be too far over your skis holding commodities, gold, etc. We've been writing a lot about that in terms of max defensive position, talking about raising cash for months now to be in a better position, give yourself optionality, hedge volatility.
And here Luke Gromen retweeted President Biden and said, it is hard to overstate how badly this tweet is going to age unless the Fed reverses course imminently. So Luke is warning that central banks, and in this case the Fed, where they're heading with monetary policy in raising rates and taking liquidity out of the market is going to have an impact on the economy and especially on financial markets. And Danielle DiMartino Booth agrees with Stephen Van Meter, who said the Fed isn't going to bail out the stock market this time. However, she said the Fed cannot let credit risk come unglued, aka see Lehman. Mortgage payment to income ratio, not as bad as in the last real estate bubble yet, but getting closer. Now, interest rates were much higher back then also. So let's wait and see what this mortgage payment to income ratio is after interest rates rise. And might I say, this is a US chart for my Australian followers. This is nothing compared to Australia. So here we've got a chart from Tavi. Says, keep an eye on this. Heavy truck sales just contracted by 23% year on year. Since 1967, every time we experienced this rate of decline, a recession followed. And from Austrian economist Daniel Lacaille, Xi calls for all-out infrastructure push. China's President Xi Jinping made a bold commitment to boost infrastructure construction to bolster the economy. Planned investment this year amounts to at least 14.8 trillion yuan or 2.3 trillion US dollars, according to Bloomberg. So they're going to be needing a lot more commodities. Supply and demand. So Mr. Deflationist himself, Henrik, says nobody ever understood gold, the major correction since 2011. I've stated that for years. We are finally approaching last low in miners. Fantastic opportunities ahead. This one, 30 to 40x if purchased at the bottom. Structure is clear. Well, I agree. I think miners are the cheapest thing, cheapest asset class out there. And you thought Germany's PPI was high. Have a look at Spain's PPI, pushing 50%, 46.6% in March. So with Australian CPI coming out at 5.1%, which was hotter than the market thought, they were expecting, what was it, 4.5, 4.6, 5.1% year on year. But when you have a look at the non-discretionary sectors, they were at 6.6%. Well, once again, if you have a look at rent, the ABS, a large portion of the CPI number is made up of rent, and you have a look at how much they thought rent went up by, and then look at the real market, which is recorded from CoreLogic and SQM Property Research. The 5.1 number is just not even close to what it really is. So here's Australia's rent. So have a look at that. You've got the CPI rents, and look, they reckon rents barely budged in the last year. Barely budged. And then have a look at CoreLogic and SQM. Have a look at their rents. And then remember, rents are the largest part of the CPI number. So underreporting, mate, it happens in the US, happens everywhere, happens here. And the cash rate, futures market has the cash rate predicted to be 3.5% by August next year. So, what, 15 months away? We're looking at 3.5% as the overnight cash rate. So, if we get there, what are mortgage rates going to be? So here we've got the managing director of the IMF, who anticipates dramatic currency depreciation and sovereign defaults this year.
We have to help countries restructure that early. And if we don't, down the road this year, we may be in a very difficult place. You talked about the 50 basic points. Just imagine what it means for emerging economies if on top of it their currency depreciates, which is also possible, and capital starts seeking the comfort of coming here to the United States.
And coming in from Barron's, the World Bank warns that the world faces the biggest energy shock since the 1970s. They say energy prices have surged since the Russian invasion of Ukraine, along with other commodities, are likely to remain at historically high levels through 2024, endangering economic growth, the World Bank warned on Tuesday. And we had US GDP come out last week, which fell 1.4% in the first quarter. So we've got high CPI and we've got a contracting economy. What does that tell you? We've got stagflation. And I only did this video a couple of weeks ago where a large global macro fund manager was warning that we're heading to a 1970s style stagflation. In fact, we're already there. I highly recommend you guys watch this video if you haven't. I'll put a link in the description below. I won't go into too much more detail on this video about this stagflation, but go check this video out. And I did this video, which I think is highly important. Don't fight the Fed. And this is the conundrum that central banks are in right now. The fight is, do central banks withdraw liquidity and raise interest rates to try to combat CPI, to try to combat inflation? Or do they protect asset prices, not raise or stop raising, reverse, and then we see inflation and the devaluation of our savings? So if you haven't watched it, I'll put a link in the description as well to this video, because this is really the battle that's going on right now. And so I shared this chart in the commodity supercycle video that I did, and also I'll put a link in the description below if you haven't watched it. And yes, even though I believe we're in the early stages of a commodity supercycle, you can see that they don't go up in a straight line. There's actually quite big retracements during these super cycles. And like the 1970s, we had the stagflation. So we had a poor economy. We had recessions while we had high inflation, high CPI. And I've said over and over again that I think we're in an inflationary decade ahead. And I still stand by that. So I see higher CPI for the rest of this decade for all sorts of reasons, which I've outlined on this channel over and over again. But I do see, and I've mentioned this again, 1973-74, where the stock market went down 50% in nominal terms. So we had CPI at 12.5% in 1974. We had the central bank raising rates, the Fed raising rates, and we had the stock market falling 50% in nominal terms. And so in short periods of time, do I think that can happen? Absolutely. However, as Luke said, depends on your time horizon. If your time horizon is in the next year or two, then maybe you should cash up. Maybe you should be a little bit careful rather than being all in on the whole commodity trade. Now, if you're patient and you're happy to wait, 3, 4, 5, 6, 7, 8 years right out to the end of this decade where I think it will peak, then fine. We know what the end game is. We know the long game, but it's the path getting there. And here's a chart that shows that 1973-74 bear market. And you can see that it started in January 73, lasted for just over 1.5 years. So 1.5 years. So imagine it started similar to now. So the stock market started falling earlier this year, and it lasts 1.5 years. So we're talking about, the second half of next year, if this plays out in some sort of similarity, some sort of similar way. And the S&P 500 index dropped around 50% before bottoming out. So if something like this was to happen, then having some cash as part of your portfolio, you could really pick up some very, very cheap stocks. So yeah, I think we are in an inflationary decade ahead, but we're going to have bouts of asset price falls, just like we had in the 1970s. We're going to see interest rates go up, go down. We're going to see CPI go up, go down. We're going to see commodities go up, go down. But like a commodity super cycle, we know where the long game is, where the end game is. And, this is on this channel, and I talk about silver in particular. And my own personal conviction, my own personal opinion is that by the end of this decade, we will see $100 silver. We will see $100 silver, in my opinion. Now, there would be bouts where we have liquidity events and silver will get smashed back down to $20. Absolutely. And so, but that's just short term, and it's not going to last a very long period of time, because we're in an inflationary decade ahead due to all sorts of things, from changing the energy composition to this, electrification of the economy. ESG means less capital investment into mining. Look, go watch that commodity supercycle video I did. I'm not going to go back into all of those details here, but yeah, I believe that's going to happen. But be aware, in the short term, there is pullbacks. Nothing goes up in a straight line. But fast forward to 2027, 2028, 2030, well, I'm pretty confident on where things are going to be. Now, it doesn't mean I'll hold my silver at $100. Because if silver hits, let's say, $50, and we see a 1973-74 crash of other assets that crash 50%, say housing crashes 50%, not saying it is, we don't know. We got no idea. However, if it does, then my purchasing power of my silver versus other assets, it's this wealth cycles. I will sell that and I will move into those other assets. And then I'll move back into silver. I do it just, you just got to understand the nuance between markets in the short term over the long term. The short term cycles over the business cycle, over the long term cycle. And I just want to highlight a video that George Gromen has done entitled, "Has Brent Johnson's Dollar Milkshake Theory Begun? Dollar Exploding Higher." Now, I've told you guys on this channel that as a part of my portfolio, I am holding US dollars. As an Australian, I'm holding US dollars. And that is based around Brent Johnson's dollar milkshake theory, which makes a lot of sense to me. And could it be playing out? Well, I certainly hope so, because that's going to be wonderful news for my portfolio and my strategy with commodities, gold and silver. So I'll put a link in the description below to George's video. I highly recommend you guys, if you don't understand Brent Johnson's dollar milkshake theory, look, a lot of gold people, a lot of commodity people like myself mock Brent Johnson and you know, all this sort of stuff, that the dollar's going to zero, all that. And yes, in the long term, I believe so. And in the long term, so does Brent. And Brent actually thinks he is bullish gold. So you need to just move away the rubbish and to see what Brent's dollar milkshake theory is all about. And Dr. Michael Burry just recently tweeted this out, and he's actually retweeted it twice. And he says, this is the problem. Last 18 months, $850 billion in direct stimmy checks, $400 billion in cash out refis, $1 trillion plus in forgivable loans, which he says most are fraudulent, another $4 trillion indirect, etc. What recapitalizes the consumer now? Higher wages can't do that. So what is he warning? He's warning that there's a liquidity shortage. So yes, we've had all this cash pumped in, which has pumped up asset markets, created a lot of the CPI that we've seen, as well as the supply destruction of that. Now, you'll remember that Dr. Michael Burry, a bit over a year ago, was calling for hyperinflation, and he still thinks that that is the longer-term game. But in the short term, as we see liquidity pulled out, interest rates rising, and no more of these stimmy checks, cash out refis, forgivable loans, etc., basically warning, you know, of some pretty, I'd say, tough times if you're highly indebted and highly indebted in speculative assets. But here's the real conundrum. If we have a look at this chart between 2002 and 2014, 53% of the $11.7 trillion rise in US federal debt was bought by central banks as FX reserves. All right, and you can see that in this chart. But when you contrast that from 2014 to now, just 4% of an $11.8 trillion rise in US debt has been bought by central banks as FX reserves. So between 2002 to 14, over 50%, 53% of an $11.7 trillion rise in US debt was bought by central banks around the world as FX reserves. From 2014 to now, that's 4%. So the biggest marginal buyer of US treasuries between 2014 and now has been, you guessed it, the Fed and US banks. But as I've shared, Jamie Dimon said that they're no longer going to be using liquidity to buy longer-term securities, to buy treasuries. So they're not interested in helping the Fed with quantitative easing. So this is the conundrum. But then on the other side of things, you know, we've got the Keynesian wealth effect, and that's really what's driven the economy in recent years, or you could even argue recent decades. So, you know, this chart, the wealth effect monitor and the Fed's money printer era, bank reserves, and you know, there's a whole heap of nuance on that, which we won't go into. But you can see that the top 1% has benefited from central banks pumping liquidity into the market and artificially lowering the true cost of currency, the true cost of borrowing. We don't have a market rate of borrowing that incentivizes savers and true investors that invest into capital accumulation and production and you name it. So, you know, we have politicians saying we need to smash the top 1% and the billionaire class and all this sort of stuff. Well, what's one way they can do it? Just reverse the wealth effect. The Keynesian wealth effect. And I've argued this in other videos that is the plan, to reduce asset prices. Yeah, sure, that's going to hurt, the bottom, but it's going to hurt the top a lot. And perhaps that may cool demand or bring demand down to the supply level. It's not going to be much fun. It's going to be a very stagflationary and very painful experience. But this is the conundrum that central banks are in right now. Do they protect the dollar or do they protect asset prices? Do they, they can't do both. All right, so I'll leave you guys with this picture of Iron Mike. Iron Mike Tyson. You're probably wondering, what the heck, Steve? Why are you finishing this video with a picture of Iron Mike? Does anybody recognize anything out of this picture? Do you notice anything? Some little detail there. Did you see the book that Iron Mike was holding? Basic Economics from Thomas Sowell. Thomas Sowell is one of my favorite economists and philosophers of all time. He's probably knocking on the door of my top 5 favorite economists and philosophers of all time. He's definitely in my top 10, but he'd be knocking on the door of my top 5. Yes, he's not an Austrian, but he is a Chicago. He's a free market supporter. And if you guys don't follow him on Twitter or read his stuff, I highly recommend it. Very good. And so it's so good to see Iron Mike getting a good education. Like I've noticed, a lot of people have recently come across Austrian economics, and you can see the change in their thinking and the change in their outlook towards life and to this world, and I think for the better. And so I highly recommend you guys study Austrian economics, but I don't mind Thomas Sowell as well. Anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. Once again, if you like this video, please hit that like button. We do appreciate it. Thank you so much. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.